Thanks for joining me today. My name is Jay McGowan. I'm the Director of Financial Planning here at Five Plan Partners. And today I want to discuss charitable giving and some strategies that could potentially not only help you help the organizations that you care so much about, but also potentially help you save some tax money in the process. First strategy I want to talk about is what we call a donor advised fund. So basically, the premise of a donor advised fund is that you take a lump sum and you contribute to a donor advised fund and you get the charitable deduction for the amount you contributed in that year. And then in subsequent years, you can give to the charities of your choice throughout those years. So basically, this is a great option for people who are in a year where they have extraordinarily high income, or in the future years, their income is going to go down significantly. So basically, let's use a round number. Let's say you want to give $10,000 to charity for the next 5 years, but you're not going to have much income after this year. So basically, what you can do is you could take $50,000, put it in a donor advised fund. You get a charitable deduction for the $50,000 in the year where you have the income. And then in the subsequent years, you can give $10,000 a year in each one of the next 5 years to the charity, actually give that to the charity. So you don't have to give it to them all at once. So it allows you to get a charitable deduction when your income is higher, but also give to charities on your schedule. You can actually also invest the proceeds or the contributions that you put into a donor advised fund. So there could be a potential to get some earnings on those dollars as well, so you can give more to charity. The second strategy I want to discuss is gifts of appreciated stock. In lieu of giving cash donations, if you have stock in your taxable or brokerage type investment accounts, you actually have the ability to give that stock to a charity directly. That is a good thing and can be a very big benefit if you have stock in your portfolio that has a very low cost basis. Basically, you get the charitable deduction based on the fair market value of the stock the day you give it. And so and you don't have to pay capital gains tax on that because you didn't make a sale. And when the charity receives that stock, they receive it at the fair market value, and they can sell it if they're a qualified charity without triggering any capital gains. So that can be a very good strategy for people in that situation. The third and final strategy I want to talk about is called a qualified charitable distribution. So for people who are required to take minimum distributions from their IRA accounts, or what we typically refer to as RMDs, you can actually satisfy your required minimum distribution out of your IRA by giving from the IRA directly to a charity. So you can satisfy a portion or all of your RMD by doing this. The limit on how much you can give is $100,000 per year as a qualified charitable distribution that would offset your required minimum distributions. This is a great strategy for anyone who is in this distribution phase who is still giving to charity. For those people who take the standard deduction on their tax return, this is actually what we call an above the line deduction. So basically, it just reduces your adjusted gross income. So you don't get a charitable deduction, but your income is reduced. And so for people who are taking the standard deduction and they don't itemize their deductions and get the benefits of a charitable contribution anyway, by giving the required minimum distribution directly from the IRA to charity, you reduce your adjusted gross income, and then you get your standard deduction, so you're in a better spot. This is really a good idea for those who are itemizing as well, because by doing this, it reduces your adjusted gross income that could potentially drop you into a lower Medicare premium bucket. And there's several other things tied to adjusted gross income. So doing a QCD is a great idea for anyone who is in required minimum distribution phase who's also still giving to charity. These are some of the more common topics that apply to a lot of individuals. They are very dependent on your specific situation, whether or not these are a good idea or not. So if you have any questions about these strategies or any other strategies, and as it relates to your financial blueprint, please feel free to reach out, give us a call. We'd love to do some more analysis for you and help put that together. Thank you very much and have a great day.